Joining me now, we've got Matt Powers, Powers Advisory Group Managing Partner here. Matt, great to have you back on the program with us. I want to talk about one of your topics heading into 2025. A lot of people are focused on, will I get my package in time or not? And that frame of mind might permeate over into 2025 as well with this name that you like, UPS. Explain why.
Yeah. Good morning, Brad. Thanks for having me on. It's with the way we're looking at next year and really in general, and kind of to preface the UPS, to get it out there, we're saying continue to maintain the AI trade. So Mag 7 companies that are derivatives of the Mag 7, they've got growth and defensive characteristics and high valuations, which might lead to some multiple expansion, but earnings growth should continue. So with that, we continue to talk to our clients about some different areas and more of a back to basics approach. And within there, UPS falls in that category. So to answer your question, simple here. It's an opportunity to lock in a core holding with a high yield. It's over 5% yield, and it's got a strong dividend growth. It's over the past 10 years, they're over 10%. Past 3 years, over 17% a year. But clearly, the shares have been beaten up year to date, down 18% this year, mainly because operating margins have been tightened. But it appears they're expected to improve in 2025. Plenty of positives for UPS, a lot of cyclical tailwinds. But for us, we just look at it as an attractive holding at a good price.
For the tailwinds that you're citing here with UPS and spotting with UPS, where else do you think that could also be spotted within the market as you think about some of the larger themes that could play out in investors' favor next year?
Yeah, what was interesting, and I don't, we talked about you just said something about the past week and a half, but the Dow. So the Dow, and I'll get this out a little bit, but it's it's down almost 6% since December 4th, as of last Wednesday's close, and that's 10 straight days of declines. It was the longest streak in 50 years. So the issue that we see with the Dow as an index is it's weighted by share price, and I'd argue it's dated and lacks some relevance. So United Healthcare is the second highest share price in the Dow, second highest weighting. So the United Healthcare is down like 20% in that time period, but it's we look at Amazon and Apple are towards the bottom, and they were actually up in that time period. So it's been looked at as a proxy of the economy, and it was initially built with some narrow breadth, and the concentration of the 30 companies makes it less representative of the overall economy. So the point being, 10 days made all the headlines, but you didn't see the same performance out of the S&P and the NASDAQ. They were both slightly down in that time period.
You mentioned the S&P 500. Looking out into 2025, the calendar year 2025 earnings growth expectation from FactSet, 15%. It seems like that's what analysts are looking for here. What is the pathway to that 15% earnings growth, at least as you're looking across the S&P 500 and really gauging where the other 493 non-Mag 7 players will be able to kind of step up and see some of that broadening?
Yeah, so broadening, it looks like, all 11 major sectors are actually expected to have year-over-year earnings increases in 2025. And I think we had or will have 7 of the 11 this year, which suggests broadening out. But the S&P is trading at 21 times forward earnings, while dividend growth equities, which is kind of our core focus, are at 19 times. So we see, again, going back to that back to basics approach, shifting towards value and just underappreciated areas of the market. One of my recommendations, which might be unpopular here, is the XLP, which is the consumer staples sector. A lot of individual names in this sector we like, and it's an easy way to gain exposures by just looking at the broad-based ETF. But most ETFs and funds in this area have Costco and Walmart as top holdings, which they're stretched in valuation, but we like them a lot. It's an out-of-favor sector. Definitely, again, a back to basics approach on flagship U.S. names, and most companies are dividend payers with a long history of growth.
Just lastly, while we have you here, Matt, how are you evaluating the FOMC going into next year? It seems that, of course, even with the cut that we saw come forward in their final meeting of the year, the market's really focused in on exactly where the potential for maybe just 2 cuts next year might actually need to be factored into the broader kind of growth narrative and what that spells out for the economy too, and what we're going to be hearing from companies over reports over 2025.
Yeah, great question. That's clearly in the forefront, and the recent J-POW meeting is just more part of a strategy to recalibrate policy, really, rather than maintaining the restrictive stance on just consistent expected cuts. That Fed meeting brought the rate discussion right back into the forefront of the market conversations, and we were looking at a catalyst that would move the market in either direction, and clearly appears to be back. Like I said, we were lulled into this false sense of complacency that we were marching along to the Fed's target without any bumps along the way until Wednesday. Clear that inflation reduction has stalled, but their goal is still 2% at the end of the year, next year. So we have time. And quite honestly, what happened Wednesday probably sets up for a healthier 2025. As an investor, a little shocked to the system, that there's more focus on looking at not only rewards but also some of the risks on the table.
Matt, always enjoy seeing your updates on the side here about your work in the basketball front as well here. Thanks so much for taking absolutely. Thank you so much for taking some time here. Hope you celebrated World Basketball Day over the weekend here as well here. Matt.
Always, yeah.
Great to see you. Thanks.
Yeah, good to see you too.